PLC election, and everybody being able to join in. As David said, my name is Nathan Smith. I'm the extension economist with Clemson University, located at Sand Hill Rec in Columbia. And I'm also the agribusiness program team director. And Scott Mickey, want to introduce him, also an extension associate, commodity marketing and financial specialist with the agribusiness team. And what we'd like to do this morning is go over the ARC PLC election and decision, and give you some of our thoughts on what to look at and how things look based on the current outlook. So let's see. So just to start off, as David said, I'm going to go over a little bit, give a little bit of reminders on ARC and PLC. And David, let me know if the slides aren't changing. Starting with price loss coverage, as everybody remembers, that's basically price protection in the name. It protects against price losses for the program crops, the Farm Bill program crops. And then agricultural risk coverage, we generally think about the county ARC. It offers a shallow loss revenue protection, and it's based on county, though, county revenue instead of price. And then there's the individual ARC, ARC individual. Again, shallow loss revenue program, but it's based off your individual farm across all farms in the state. So, you know, we're just going to limit our discussion to PLC and ARC county. There's very few, if any, ARC individual elections or contracts in the state. So looking at we're here talking about 2021 crop because farmers are able to change their elections for that crop year. And so just a reminder, you know, you can change, but it's not required. It's got to be unanimous, made across all producers. And if your elections aren't changed, then it should stay in effect for the current elections. And you know, no late filing allowed. And I know we got some folks on here from FSA, so if you have some, if there's anything in here that's not right or been changed, you know, throw it in the chat box or let us know. Enrollment is required for ARC PLC, and when you elect, you're enrolling at the same time, and you can do it on a crop by crop basis. And so you can pick and choose which crops to enroll or not enroll, as well as to whether you want ARC county or PLC. For an example, seed cotton, you know, the Stacks insurance policy is available on Stacks, but if you do sign up for Stacks this year at the end of this month, then to be eligible, you cannot be enrolled in ARC PLC on seed cotton. And so that's something to note and remember if you decide to go with Stacks as related to crop insurance. And you can't enroll some of your seed cotton base in PLC or ARC, and then another part not enroll. It's got to be all or nothing. So reminder on the timeline, and I think there may have been a few questions about what do these elections apply to? They apply to the 2021 crop year. So the 2021 crop that y'all getting ready to plant, as David mentioned, the deadline is March 15 for that crop. But just remember that payments, if there's payments triggered, whether it be ARC County or PLC, they're lagged a year basically from the harvest. I guess I lagged a year on the spring planted crops anyway. Where the payment comes in October of the following year. And so we're in the 2020 crop marketing year right now. And those marketing years generally end around July, August, September. And so any payments that are triggered on 2020 crop will come in October 2021. And so the election that we're talking about today for the 2021, that would be, if triggered, that would be paid in October of 2022. Just a quick refresher on price loss coverage. You know, payments are made when the effective price falls below the reference price for that covered commodity. And so again, it's triggered by price. The effective price is either the marketing year average for the crop or the national loan rate, whichever is higher. So with where our loan rates are, it's basically the marketing year average price for that covered crop. And the reference price is set, it's fixed by the Farm Bill and through 2023. And payments are made on 85% of the base of that covered commodity. And again, you don't have to plant the crop to receive the payment if one's triggered on that base. It's not tied to planting. You just have to, it depends on what the base is on your farm. And so here's a reminder of the reference prices for PLC, and I just highlighted the ones that basically we have at least going into the 18 Farm Bill, the base acres for the major commodities that apply to South Carolina. And so, you know, it's all the major crops: corn, soybeans, wheat, and grain sorghum, peanuts, seed cotton, and a little bit of oats and barley and canola and sunflower seed out there. ARC county, again, is revenue based instead of price based, and it's triggered when the actual county revenue falls below a county benchmark guaranteed for that covered commodity. So the county yield is used, and most with the 18 Farm Bill, there if the RMA county yields available, that's used, but it's not based on individual farm or individual yield. So when the county yield or combination of the county yield and price drops the actual revenue below a county guarantee, that triggers a payment. One difference between ARC County and PLC is that the payment rate for ARC County is limited or to 10% of the benchmark revenue. So that's why it's called a shallow loss program. And like PLC, it's made on 85% of the acres of that base acres of that covered commodity. And again, same thing. It's not tied to what you plant. You don't have to plant your bases. It's just if you've got base on the farm for that particular commodity that triggers a ARC County payment, then you get that payment based on your base acres, 85% of them. Real quick PLC example, we're looking at corn here, and there's the formula, the payment rate, the FSA posts the payment rate on their ARC program data landing page, and they track it through the crop year. And so that whatever, if there's a payment rate triggered times the PLC payment yield or program yield times 85% would be the PLC payment. So in this example, if the reference price has been $3.70 basically for corn, and so if the marketing year average price came in at $3.60 in terms of the market year average price was $3.60, then the payment rate would be 10 cents. 360 minus 70, 370 times the program payment yield times 85%, or in that case, it would total $11.48 per base acre. So that's, and as prices go down, the payment goes up, and that's basically how the PLC works. Pretty straightforward. All right, let me see if I can get it to. All right. So I got to erase here. Sorry, I'm trying using the annotate here. On ARC revenue coverage, county, again, payments are per acre if the actual county revenue falls below 86% of the county revenue benchmark. So it's ARC County is triggered when the actual revenue falls below 86%, and then it's maxed out at about 76% of the revenue. So the maximum payment is 10% of that benchmark. And the county benchmark revenue is the 5-year Olympic average of the market year average price or national price times the 5-year Olympic average of the county yield. That means you're dropping the low and the high yield over the 5-year period and taking the average. And again, it's paid on 85% of the base acres. Okay. So that's a quick review reminder on ARC PLC. And I'm going to talk about peanuts.
Nathan.
Yeah, sure. David.
Before you start on the peanuts, just wanted to, Richard made a note in the chat that you are allowed to make these election choices by farm number. The Richard Gettings from Sumter.
Yep.
Make sure everybody knows they can choose by farm numbers.
I appreciate that, Richard. Yep, good point. That you can do it by farm number. So crop by crop and by farm number. All right. I'm going to talk a little bit about peanuts and seed cotton, and then Scott's going to, he'll actually go a little more detail on examples with ARC County and PLC and show you some numbers. And he'll talk about the major commodities that we're looking at in South Carolina. So with peanuts, let's see. All right. So I charted out the market year average price for peanuts going back 30 years. And if this program was in effect, the red line is the reference price of $5.35 a ton, and the green line is the loan rate of $3.55 a ton. And you can see since the 18th Farm Bill and going back to the previous Farm Bill too, a PLC payment is triggered for peanuts. In other words, the blue line's been below the red line, and that's been a significant payment. You know, the peanuts is per acre payments has been the highest in terms of how the PLC payments. And so I'd say 99% of the state is probably PLC on peanuts in terms of elections. The price is posted each week, the weekly price for peanuts by NASS, National Agricultural Statistics Service, and this chart is part of their weekly release, and it's showing the 2020 is the red line, the 2020 crop, and the blue line is the 19 crop. And you see 19 averaged about $412 a ton. And this is for all peanuts, in other words, all types, runners, Virginias, Spanish, and so they average those prices reported weekly for a national market year average price. And the red has been some same, a little bit above because of the drop last year, but your conclusion here is it's tracking pretty close to this, but might be a little bit higher. Right now, the projection for the 2020 crop is around $430 per ton or $105 a ton payment, very similar to the 18 crop. And these are the payments going back to the 14 crop on peanuts. But again, the election is not going to affect, I mean, it's not tied to the 2020 crop. This is for 2021. And so what's 2021 looking like? You know, so I've heard some Virginia type contracts coming out at around $520 a ton, runners around $475. I think with what's going on in the market with the other crops, it's helping peanut prices some, as well as some other factors this year, going into 2021. When you look at consumption for peanuts, domestic consumptions has been strong with the pandemic, COVID-19 pandemic. We've seen peanut butter sales and use go up quite a bit, in candy use, and so that's going to help reduce the stock situation some. Last year's crop was a high quality crop compared to the previous year. Exports are tracking along about last year. They may be down a little bit, but we still got 6 months to go in the season, in the marketing year. So if we were to end up with around 500 or a little more average price, a market year average price, then that would still probably trigger a PLC payment for 2021. But it might be $35 a ton or somewhere in that range. So to be honest with you, it's a little bit like throwing darts at a dartboard to know what the price is going to end up being a year and a half from now. But that's kind of the trend and the best outlook I can give on it right now related to peanuts. Seed cotton, similar chart on seed cotton, and of course seed cotton is a calculated price using upland cotton lint production and prices, and cotton seed prices. So in this chart, the lint price is the green line, and the cotton seed price is the gray line, and it's a weighted average between the two, and coming up with the blue line, the seed cotton price. And I went ahead and put in the 2020 seed cotton price, which is around 34.5 cents a pound, which is still below the reference price of roughly 36.7 cents a pound. So about 2-cent payment if it were to end today, with what we would expect on seed cotton PLC payment. So if you had 100 acres of base of seed cotton, and say your PLC program yield, payment yield is 800 pounds, and the current projections at 34.64 cents per pound, then converting that 800 pounds into seed cotton pounds, multiplying it by a factor of 2.4 gives us 1,920 pounds in seed cotton payment yield. And you take the 2-cent payment rate times the yield. That's a little bit, that should be less there, but times 100 acres times 85%, it's going to be a little less than $30 an acre for the 2020 payment, PLC payment. So in 2021, cotton prices are up right now. Here's yesterday's futures chart, or the day before. So they've been trading between 78, 79 cents the last week or so in terms of cotton for 2021 December cotton. And so there may not be a seed cotton payment for PLC in 2021, but we don't know. There's still a lot of time for cotton, and the fundamentals are a little different on cotton, maybe in terms of shortage of cotton compared to the corn and soybeans. And so in terms of where I think things are and might go, I'll just give you my basic philosophy on PLC and ARC for peanuts and cotton. When the program was developed in the previous farm bill, you had two basically camps in writing the farm bill. You had the Midwest, the corn and soybeans, that favored an ARC program, and you had the southern grower crops that favored a PLC program. And so we ended up with both in the Farm Bill. And PLC was basically designed with peanuts and rice in mind, and then seed cotton was designed in the same way once it was added back in, as a program crop. And so PLC generally, with where the reference prices are for those crops, PLC generally favors those crops versus ARC County. So, you know, in the long run, you know, to me, PLC is a straightforward decision on peanuts and seed cotton. But, you know, from year to year, you might consider changing. But I think with where prices are right now and expecting some type of payment or the probability of triggering a PLC payment, I think is still better than an ARC County payment, unless we have a big weather event in terms of 2021, and that's what we hope doesn't happen. So, and if you do want some type of ARC shallow loss protection, you can do that with SEO coverage, crop insurance coverage, and so that's available, as well as if you just want to increase that coverage, you can do individual buyout. So I think you can do the same thing, and you'll be better protected if you go the individual coverage as far as risk management. There are a couple of decision aids that are running or available. You know, our agents have used these before. The Texas A&M Ag and Food Policy Center has a simulation model. And Kansas State has a spreadsheet tool that they download, but Scott's put together a comparison table based on current data that I think you might find useful in trying to make the decision this year. I'll put the caveat out there. There's a lot of missing data right now in the Kansas State tool, so depending on your county, all the crops might not come up or show numbers. And A&M is running their model based on trying to use some historical estimates for counties that are missing some data. And so the data that's been released out of DC has not been all data for all counties. And so we're kind of making decisions really based on, you know, where prices are right now. And where we think they might be in a year and a half. So with that, I'm going to stop there, David, and turn it back over to you, unless there's some questions that Mike could answer.
Nothing showed up in the chat other than Richard's comments so far, and I think we'll just move on to Scott, if that sounds good, and he might answer some questions people have, and then we'll open up for questions at the end. Scott's got some, I think Nathan did a good job of introducing Scott, so I won't blow his head up. I had a long written introduction for him, but Nathan took care of it. So anyway, Scott, we're glad to have you with us. He's going to run county examples, county by county. He's got some slides and stuff, and I hope he's going to give you some good advice about marketing that I encouraged him to do also. So Scott, take it away.
All right, thank you, David. Just going to follow up with what Nathan led off with, and just kind of give you a few more examples and some of my perspectives on how this ARC PLC might play out. And I think to get that perception set, I like looking at this chart because there's a lot of risks that your business is facing besides trying to make an ARC PLC decision today. But, you know, you've got people risk, you know, you've got production risk, market risk, financial, and legal. And so, you know, I realize that in the whole scheme of things, this is a very important decision, but it's just one of many that you need to manage your risk effectively in 2021. As Nathan alluded to, there's some missing data, and just before I go into examples and things, I want to kind of point out that, you know, we've done the best we can, but This data is coming from some tables and information that FSA posted. And for this 2021 marketing year, which we're in right now, on the website, they're showing data from January of 2020, over a year old. I think this is the correct data down here, and I think this is where the typo is, but again, I can't get confirmation on that. So, I mean, there's just a little bit uncomfortable as we move through some of these models. On the other table, looking at these effective reference prices, again, it's saying it's from January of 2020. They were striking out 4 years, and in Olympic average, you only need to strike out 2. But when I did the math, I think these numbers over here on the right side are correct. But just a little bit of concern about where this data is coming from. So Nathan did a good job of introducing the different reference prices we have for the commodities we grow in South Carolina. And I just want to kind of put those reference prices in perspective with where our prices are today. At the end of January, my calculations for what the crop insurance base price was going to be are these levels over here on the right. So for corn, we were looking at a crop insurance price of $4.63. Comparing that with our reference price for the PLC program of $3.70. Hopefully by the end of the day, you realize that collecting a PLC payment is not going to be a win-win situation for most of you. Because right now we've got much better pricing opportunities than trying to pick up some PLC payments or ARC payments. And to kind of give an idea of where prices might be going, or, you know, are we going to see prices tank down to those reference price levels? I think it's important to look at the supply and demand tables. These are put out by USDA. They're called the World Ag Supply and Demand Estimates. They're put out around the 10th or 12th of every month. And this was the latest report in January. And then these colored columns are estimates that I put together based on things I read and hear about what the crop acres are going to be in future years. So the year that we're marketing right now is the crop you harvested last year. And we can see that our ending stocks dropped quite a bit. And the number I want you to focus on is what this percent use is. And that means how much of our ending stocks do we have relative to the total uses we had during the year. And the crop we just harvested, we have about a 9% stocks to use ratio, which is relatively tight. And that is down from a 14% the year before. And when you look at what the marketing year prices were, the year before when we had ending stocks to use of 14%, that USDA price was $3.56. This year, when we have a 9% ending stocks to use ratio, that USDA expected cash price is $4.20. So you can see that, you know, we expect better prices because ending stocks are so tight. When we look into the crop you're going to plant in a few months, the 21-22 crop, if we plant 93 million acres in the US and harvest just under 180 bushels to the acre, and we use 15 billion bushels of use, we're going to increase our ending stocks, but they're still going to be fairly tight. Not as tight as they were this year, but tighter than they were back in 2019. And so for that reason, I'm optimistic that our prices should stay fairly strong. We may not stay in this 420 range. I don't think we'll be going back to 356 based on our current estimated production for 21-22. When you look at soybeans, it's even more drastic. The ending stocks here are 3%. That's extremely tight ending stocks to use. They were 13% the year before. even if we bump acres from 83 million to 90, we still expect Indian stocks to be well below the 10% pipelines size at 5%. So soybeans Indian stocks look like they're going to be tight for the next couple of years. Again, you can see the difference in these USDA prices when Indian stocks were above 10% and below 10%. Quite a big swing. Wheat, on the other hand, is a different story. Our Indian stocks to use are quite ample. We've got 38% of our next year's use on hand when we start the year. That doesn't look to be changing anytime. And so we may continue to see wheat prices, below the reference price, giving us some opportunities on the PLC side. So let's just cut to the chase, and we'll look at some expected government payments for ARC and PLC and just 5 random counties in the PD area. I'm using the current marketing year average price for the 2020/21 crop year. This is not the marketing year average price that will determine the ARC PLC payments for this year. These are the ones for last year, okay? But we don't have any better guess at what that marketing year average price is going to be. So you can see that on corn, we'll just start here with Clarendon County. We have a non-irrigated type with a 420 expected marketing year average price. The ARC County projected revenue is $509. The expected ARC County yield or payment would be $0. The expected PLC payment will be 0. If you go to Darlington, it's got a lower projected revenue, but the same payment, expected payment. And you can see that right now for corn, we would not expect to collect an ARC or PLC payment in the fall of 2022 for the 2021 crop year. But nevertheless, we need to make a decision, because just because this price is $420 now, we don't know what may happen between now and 2022. So let's just stick with Clarendon County. These examples are available for every county in the state. Your extension agent will have these. So if you want to look at your county, the tables are available in the crops that we have information on. But first thing I want to do is just go through this, and we've already talked about what our projected payments are. They're going to be 0. But to calculate that ARC County payment, Nathan or Dr. Smith went through that. First thing we have to do is figure out what our benchmark revenue is going to be. And that's simply taking the ARC County yield, which is 121 bushels in Clarendon County, times the ARC County price, which is an Olympic average of the last 3 out of the last 5 years. And currently that's at $3.70. Multiply those together, and that gives you the benchmark revenue of $448. Because this is a shallow loss protection program, we're only going to guarantee 86% of that benchmark revenue. And so when you multiply 86% times $448, you get a guaranteed revenue of $385. If you're not confused yet, just remember that you can only get a payment up to 10% of this benchmark revenue. So the maximum ARC County payment in Clarendon County for corn will be $44.81 an acre. So what's that mean? I mean, what's got to happen before we trigger an ARC County payment in Clarendon County? Well, if we wanted the maximum payment yield and the price stays at $420, the county average corn yield in Clarendon would have to drop 33% to 81 bushels an acre. And that would end up giving you this maximum payment of $44.81. If the price if we wanted to, let's say we make 121 bushels, but we still want the maximum payment, the price has to drop 33%, and that would be from 370. I'm sorry, from the 420 down to the 281. Okay. I don't know how many of you would be very excited about having corn prices drop from 420 to $2.81. That'd be kind of scary, because I don't think $44.81 is going to make up for our loss. But we'll look at that. But let's look at a more realistic situation. What has to happen to collect $10 under ARC PLC? Well, the yield would have to drop to 89 bushels, which is still a 26% yield loss, or the price would have to drop to $3.09 a bushel, or some combination in between. But we would need to see that revenue drop 26% from where it is currently to trigger a $10 payment. Just think about that and keep that in your mind. 26% drop in revenue to pick up $10. So let's look at the PLC situation. It's a little easier to follow because it's just price loss coverage, as Dr. Smith explained. So if the reference price, if the marketing year average price is less than the reference price, PLC triggers. And so in this case, we're well above the reference price. We're 50 cents higher at 420 than 370. To trigger a $10 payment on PLC, we would need a price drop of 14%. And that means that the marketing year average price would drop to 361. PLC payment would be, if it drops to 361, the payment would be about $9.81. If we get a 33% price loss, and remember that's what triggers the maximum payment under ARC, a 33% price drop creates about a $100 PLC payment. So these programs work differently. This one is a combination of yield and price, and this one is simply price. So here's my observations. Number one, a 14% price drop from the 420 to 361 would work out to be about a $71 an acre revenue loss on corn. That's a 59-cent price change on 121 bushels. And we're going to give up $71 of revenue, and we're going to gain a $10 PLC payment. If that sounds like a good deal to you, let me know, and I'll give you $10 in exchange for you giving me $71. The second one is, suppose we have that 26% yield drop, and this is really looking at the PLC. This 26% yield drop from 121 to 89 bushels would result in a $133 revenue loss on corn, and we would be able to pick up a $10 ARC County payment. If we have that 26% yield drop, we would trigger our crop insurance if we have 75% revenue protection, but only 1%. So basically you'd get a crop insurance check for $4.63 for the 1 bushel underneath your guarantee. Probably the third observation I'll make is that we need several more years of prices like they are today, with the marketing year average price at 420 to raise those ARC benchmark revenue numbers. And then I think ARC might come into favor again. But right now we've got a lot of low prices and low revenue years. And the ARC benchmarks are just very low relative to expected revenue. And so even if we have one good year of 420, that price gets kicked out because the Olympic average throws out the high and the low. So we need at least 2 years of higher marking year average prices to get the ARC benchmark revenues higher than they are today. My preference would probably be PLC on every crop except for soybeans. And the reason for that is I just prefer not to bet on a yield disaster or price losses. So I like the PLC better than ARC, except on soybeans, because we've never had a PLC payment on soybeans, and the price would have to drop from that $11.15 level to $8.40. And based on the supply and demand tables, I just don't think that's likely to happen in 2021. So I'm going to close with a couple slides that David saw these yesterday, and I tried to soften them up a little bit. But I want you to think about how much time you've invested in making your ARC PLC decision. How much time have you put into this, since October or whenever you could first make an election? And then the second thing I want to do is compare that to the amount of time that you may have invested in your marketing plan this year. Because I think the examples I worked through showed the importance of understanding what the market is offering you today and comparing that to what has to happen to collect ARC PLC. And I'm pretty confident that a marketing plan will provide higher returns in 2021 than ARC PLC. So I'm going to go back to that Clarendon County example, and this works for pretty much any county out there. But I'll just give you one simple marketing strategy that you might want to think about and talk with your marketing advisor about. But as of Friday, and I don't know what these prices are today, I could buy a $4.70 put that will give me a minimum price of $4.70 a bushel for corn against September, and that would cost me 46 cents. And I could sell a $5.20 call, which means I can't sell my corn for more than $5.20, but I could collect 30 cents for that option today. So my net cost would be 16 cents a bushel. If I wanted to protect 25% of my expected production in Clarendon County, that average would be about 30 bushels of corn. And if I spent 16 cents a bushel on 30 bushels, it would cost me about $5 an acre. But for $5 an acre, that's going to basically give me a $4.70 floor minus the 16 cents. And then I just used a simple 50 cents basis on here. But that would put me in at a $5.04 as the minimum price for corn in 2021. It would also give me the upside all the way up to $5.54. And so I did some similar things for soybeans and cotton and wheat. And my point is there's some opportunities to lock in some prices to protect some of the opportunities that we have today. And then if we have our crop marketed well and prices drop and we pick up a ARC payment or a PLC payment, we're just going to add it to our crop that's already been marketed at higher levels. So I'm going to leave you with that, and if there's any questions, I'll be glad to answer them. If you want to look at any particular counties, I can show you some more. This is Darlington County, the corn, soybean, wheat, seed cotton, and we do not have data on peanuts. But so with that, David, I'm going to turn it back to you, and then we'll just take questions the time we have left.
All right. Thank you, Scott. I think that summarized it pretty well. We did have a few folks asked about some oats and various things like that. I assume that would just fall under the same thoughts you have as with PLC, or you got anything specific on some of these odd crops?
I think the oats would probably still be PLC. Again, I think take a look at what your base acres are. I think the ones I've looked at has been 2 or 3 acres of oak base. So
Yeah.
by the time you take 85% of it, or only collect 85, it's not a huge thing. But oats would probably be the same as these other crops.
All right. If anybody has any questions, feel free to unmute yourself or put them in the chat box. This form that Scott has on the screen right now, we do have those available for all the counties. Recognize on the call, we have Heather Benjamin with Florence and Williamsburg counties on with us. Hannah Michael with Sumter and Clarendon counties on with us. Rich Bird has Darlington and Marlboro and Chesterfield. And then William Hardy is Horry County, Marion County, Dillon County. So those are your agents locally. We'll all have these for each county. Scott sent that out to us that we can help you or get these to you if you want to look at them. Does anybody have any questions for anybody? Got a few in the chat coming in. Yes, we'll make this video. We'll email it out to everybody that was registered. We'll clean it up a little bit and get it sent out to you. And I don't know if Nathan might have a place to put it on his agribusiness website or something. We get it cleaned up.
We can post a link to it if you send a link once you get the recording.
Right. That's what we'll do.
Yeah.
Scott, we got someone wants you to go through the put and call example again. If you could run through it to
All right.
help us understand a little better.
All right. Are you okay with just sticking with the corn example?
Yeah, I think that'll be fine.
Okay. So a $4 put, a $4.70 put, if the farmer buys it, he's buying the right to sell corn for $4.70. For the right to do that, he's willing to pay 46 cents a bushel for it. Okay, so if you want to just look at the put component, if you just bought puts, you would have a floor of $4.24 a bushel. That would be the minimum price you could have if corn goes to $5. You would be able to sell your corn for $5, but you would still have paid that 46-cent premium. Selling the call gives somebody the right to buy corn for $5.20. We're not interested in buying corn at $5.20, but if somebody else wants to buy it, we'd be glad to sell it to them for that. And so by selling the call, that's giving somebody the right to buy corn for $5.20, and they're willing to pay you 30 cents for that right. So if I spend 46 cents and collect 30 cents for selling the call, my net cost 15 cents. And so I have a floor of 470, subtract 16 cents, that gives me 454. And then I just added a 50-cent cash basis to say that my minimum cash price would be $5.04. I would try to do it on about 25% of my expected production, and that's why I did 30 bushels to the acre. I said the same thing I said before probably, and so if you could share more details about what you'd like me to explain, I'd be glad to talk to you about it.
One question is explain the 50-cent basis. That's what you're getting at. I'll let you do it, Scott. It's your show.
Okay. The 50-cent base is just what I'm going to get. Like when I sell corn to a feed mill, they will usually offer you something over the Chicago board price. This 470 and 520 are based on the Chicago Board of Trade prices. The 50-cent basis is what the elevator or feed mill is going to pay me in addition to whatever the Chicago futures price is.
that's something you may not receive if you take to a local elevator or something and not directly to a processor. You might not get that kind of a plus basis.
You may get 0 basis. So if you got
That's right.
even, this would be $4.54.
Right. We had one other in the chat box. I think Nathan kind of explained it, but Nathan, you want to maybe elaborate on that question? The question was, you mentioned that for cotton, if a farmer withdraws one farm number from PLC and doesn't participate, can he leave the other farms in the PLC program?
Yeah, you can. Again, it's crop by crop as far as elections and enrolling. So if you decide not to enroll seed cotton for 2021, you can still enroll the others, or change the election for the other crops, and do it by farm, as Richard mentioned. So.
All right. Anybody else have any questions while we got?
I was going to mention.
Okay.
So the question was about oats, and you know, for the 2020 crop, barley and canola actually are showing triggering a PLC payment right now, and a very small one on sunflowers. And so, you know, and looking which way the prices have pretty much dropped for all those crops over the last few years, so they've been lower. Like I said, it's kind of hard. We don't have all the full information right now on the particularly the minor crops like these: barley, oats, canola, and sunflower. But you know, prices have been historically low with them, and the trend is probably not much different than the other crops for 2021. So, but the PLC program has triggered for them the last couple of years.
All right, thank you, Nathan. Got a follow up on that question. She's really wanting to know if there's 3 farms and one is in insurance program, probably the stacks, and the other 2 aren't. They can be in PLC. I think that's what you answered. Yeah, if you make that selection for that farm number, and the other farm numbers can be chosen. Is that correct, or is cotton across the board?
Let me read that again. Doesn't.
Okay.
Okay, the other 2 farms, yeah, that's
As long as they're a separate farm number totally, right?
right.
Yeah. You just can't separate acres within a farm.
If it was partners within the farm, you can't do it that way.
Right.
They all have to agree.
But if it's a total separate farm number, they can be treated separate.
But can you buy stacks, farm number by farm number? Or do you have to buy stacks across the whole county?
Yes, that's a good point.
So I don't think you can.
It might depend on where the farm lays, which county.
Yeah.
I think that's where the difficulty comes in.
Had a comment that stacks can be bought by farm number in Lee County, apparently. So anyway. All right. Not seeing any more questions right now. I want to thank Nathan and Scott for sharing the information with us and breaking it all down for you, and Scott for giving the little marketing class to boot. That was good extra information. Thank Joshua Kaufman for putting all this together and manning it from the office. And if y'all have any questions, feel free to email any of us, and we'll try to get this video out to y'all and